Welcome back to Yahoo Finance Live. Now, from soaring inflation to rising interest rates, tech stocks have been having a rough time over the past several weeks. So have those former tech darlings become cheap enough for investors to pursue once more? Well, our very own Emily McCormick is standing by to break it all down for us. Emily.
Well, Rochelle, the time has come to buy many of the beaten down tech stocks, according to Wedbush Analyst Dan Ives. Now, Ives was out with a new note saying that now that the Federal Reserve's latest monetary policy decision and first interest rate hike since 2018 have taken place, a major overhang has been lifted for tech shares, making them more attractive, especially now at these levels. And we have seen that for the year to date, growth stocks, technology shares were hit hard amid concerns over higher rates and tighter financial conditions. The NASDAQ 100 just closed in a bear market earlier this week on Monday, which means that it slid more than 20% from its recent record high from November. And the tech-heavy communication services, information technology, and consumer discretionary sectors have been the biggest laggards in the S&P 500 so far for the year to date. Now, all of this has created buying opportunities, according to Wedbush. And here's the key point that I want to highlight from Dan Ives, who said, quote, "We believe the tech sector is as oversold as we have seen in the last 5 years, and we would strongly be buying cloud, software, cybersecurity, chips, and stalwart tech names led by FANG, with Apple our clear favorite." And to that point, Ives does see a major opportunity in Apple specifically. He expects the stock could rise to as much as $200 a share this year as supply chain concerns start to let up. Apple shares have fallen about 10% so far for the year to date. They closed up slightly today, but we'll see if investors do decide to take up this advice and start buying in earnest.
And Emily, what about some of those pandemic darlings, those work-from-home tech stocks? Are those as attractive at these levels, given how far they've fallen this year?
Well, that's a great question. The short answer is no. Dan Ives of Wedbush specifically said that the work-from-home stocks aren't quite as ripe for a rebound as some of the other tech names. And in fact, he said that these work-from-home stocks should be viewed with caution and that their valuations are likely to keep moving lower. Now, he didn't call out specific names in this work-from-home space, but of course, some of the first ones that come to mind and that have been badly beaten down so far this year include Netflix, Peloton, Zoom video communication. And to that point, I've said that investors have been wrongly lumping all tech stocks together and contributing to the sell-off that we've seen broadly across all of these names. So Ives really is making the case for distinguishing between the work-from-home names that are still likely going to be facing some challenges, and then separately the enterprise and cloud stocks that he believes are, quote, compelling table pounder buys at these levels. Now, he also said that large cap tech stocks will likely outperform small caps, as will those with defensive business models and high free cash flow. And then finally, one other subgroup that you can see here on the screen that Ives views favorably is cybersecurity. Now, with the threat of cyber attacks elevated since Russia invaded Ukraine, he did say that there is opportunity for more growth in this industry group, and he did call out some names specifically, including Zscaler, Palo Alto Networks, CrowdStrike, Palantir, and SailPoint as the most exposed to these positive cloud cybersecurity tailwinds. So again, Ives is really bullish on tech, but with some specifications for what types of tech stocks might be best positioned for more upside, or for upside period at this point.
Yahoo Finance's Emily McCormick there. Sorry for the delay there, Emily. Diving into some earnings here and after hours trading. Excellent breakdown as always. Appreciate